Okay, ladies and gentlemen, and welcome to MACROACE with your host Tony. I'm also the head financial analyst at Financial Juice. Today is going to be a recorded version of what would have been the live stream, but due to some circumstances today, it is just going to be recorded. But still, going to be providing you with the knowledge of what to expect, what could happen, what has happened in the past, and then also how the markets have reacted as well. So let's get into it then with the Bank of England. First of all, what is it? It's a rate that the bank pays interest to commercial banks. And why is it important? Well, of course, with higher rates, it's aimed to slow down growth or make sure it doesn't get too out of hand. And when rates are lowered or when you have lower rates, it's there to ensure some support or create growth for maybe a stagnant economy or an economy coming out of a recession or potentially going into a recession. It also affects how banks hand out loans, mortgages, and credit. So, where is the economy at the moment? What is the Bank of England looking at in regards to data when they're determining their monetary policy? So, unemployment rate remains unchanged at 4.2%. The unemployment change at 11.7k compared to 16k. Average weekly earnings year on year at 6.5% compared to 7.2%. CPI year on year, or the headline inflation data, at 4% compared to 3.9%. Core CPI year on year at 5.1%, which remains unchanged. GDP Q3 was at minus 0.1% compared to 0.2%. GDP year on year at 0.3% compared to 0.6%. GDP estimate month on month at 0.3% compared to minus 0.3%. Services PMI at 53.8 compared to 53.4. Manufacturing PMI also rose as well to 47.3 compared to 46.2. Retail sales year on year was down 2.4% compared to 0.1%, and the month on month was also down 3.2% compared to 1.3%. So you have a mix of data of inflation still remaining sticky. Wages are seeing some downside movement, which is important for the central bank when regarding how strong can inflation be in the future, and how much of an effect will the average weekly earnings have on inflation. But then you also have GDP data that isn't really that strong and dips into the negative territory for Q3. However, on the flip side, you also have services PMI, which is better, which has been doing better than before, and also the manufacturing PMI data, albeit still in the contraction area for the manufacturing. It is still a 1 point jump in towards the 50 area or 50 or above area, which will then show expansion within the economy. So there are a mix of different bits of data that the Bank of England is looking at and taking into consideration that makes it harder for them to determine when rates could be cut, if there are still some restrictive monetary policy that is required to keep inflation under control, but to also not stifle any growth within the UK as much as they can. So if we look at the previous Bank of England rate statement, so the Bank of England kept their rate unchanged at 5.25%. You had policymakers Green, Haskell and Mann that voted to raise rates by 0.25 percentage points. They see inflation just under 4.5% by the end of 2023 compared to their November forecast of Q4 CPI at 4.75%, and around 4.75% in January and closer to 4% in February. Measures of inflation persistence are higher in the UK than in other major advanced economies, and most of MPC majority say it's too early to conclude services inflation or pay growth is on a firmly downward path. The other thing is that they didn't really offer any pivot from their normal hawkish rhetoric like the Fed has did in the past with their rate decision. Of course, yesterday, that was a bit of a different story where they didn't really provide they didn't really provide a huge shift. They did remove some important language about the rates. So you did get some commentary from the central bank yesterday, where they removed reference to potential additional policy firming, which led to the shift in the expectation, led to the shift in the central bank and their thoughts, and getting ready to cut rates. However, they weren't that dovish. So the Fed does not expect that it will be appropriate to reduce rates until there is greater confidence and moving sustainably towards the 2%. And on top of that, Powell yesterday said that the idea of a March rate cut isn't really on the books. So from the central bank with the Bank of England then, could they push out a potential for a May rate cut? That could be a likely scenario, and then that could provide some bullish sentiment for the pound and some bearish sentiment for stocks instead in the UK. So if we carry on then, if we're looking at the sentiment of the central bankers and what they view or how they feel, you can see in the last meeting that more or less everyone was still on the hawkish side, and with people kind of stuck in the middle. But if we look at the next slide, you can see that shift towards not the easing phase or the easing side, but to the hold side for the majority of the Bank of England members, with Dingra being the outlier of expecting to be the most dovish member of the central bank. And because of that, it's important to understand that the votes that we have today, that are going to be coming out today, the voting figures are going to be quite important. Who votes for a hike, who doesn't, who votes for a cut, is all going to be quite important to understand how that sentiment or those votes could affect the pound. Now, the expectation is for 8 members to vote for no change and 1 member to vote for a hike, which probably would be Catherine Mann. However, by looking at this shift with Dingra being even more dovish than what she might have been before, there is the potential for Dingra to vote for a cut at this meeting, considering how she's always been the outlier, along with her previous colleague, Bank of England's Tenrero, who's also very dovish, who was also very dovish in her thoughts and commentary as well, and voting. So that could be the risk today, where Dingra could then decide to vote for a rate cut, and the majority vote for no change, and that vote could lead to some bearish reaction from the pound. If the expectation today is that 8 members are going to vote for no change, 1 is going to vote for a hike, and if you do get 1 member that does vote for a cut, it could provide a bit of a surprise to the markets, albeit there may be some traders who may be pricing in for the expectation that Dingra, because of how she's been in the past, with being very dovish compared to the Bank of England before, that she could be the one to vote for a rate cut this time round, and that could lead to some moderate reaction from the pound, or bearish moderate reaction from the pound from her today. So that's one potential scenario that you could have. If the votes come in as expected, then you're not really expecting too much to occur from the Bank of England, or not really anything to when I say not much from the Bank of England, I meant to say from the pound itself. But there are also other things that we have to be aware of with the pound and how it could be affected from the Bank of England. One, you have the figure. Two, you have the monetary policy report and summary. And then three, you have the vote on top as well. So there are three different things that traders have to be mindful of when considering trading the pound or trading stocks. Okay, Bank of England Governor Bailey comments and others. There wasn't really a lot over the Christmas period. There were only two that talked about monetary policy. So that was Bailey and also Breeden. So starting off with Bailey said the markets formed their own view and we are more cautious than the markets. It's really too early to start speculating about rate cuts, and there is more to do in bringing inflation down to the target, but there are encouraging signs on inflation. Bank of England's Breeden said that it's important for policy to be restrictive for an extended period of time. So this is the thing about the Bank of England when they go against what the market expects them to do. They have done in the past where they have been expected to raise rates and then they don't raise rates. And then in their statement or in their press conference, they'll say that we need to raise rates. So they'll throw the spanner in to those that are pricing in a potential for a rate cut, or could do for those who are pricing in for potential for a rate cut in May. And they could say that instead they might have to do a rate cut later on in the year rather than in May instead. That it's, or they could, or to be vague, or maybe clearer, should I say, that it's too soon to be thinking about rate cuts, and that could provide some bullish momentum for the pound if they're still in the view that they need to maintain rates at where they are for longer, albeit being open to the idea of bringing down rates once they have the appropriate settings for inflation to reach the 2% target. Investment bank and market views. So on January 19th, Fitch Ratings said they expect Fed, ECB and Bank of England to cut rates by 75 basis points by the end of 2024. January 29th, you had MUFG saying the Bank of England, while likely shifting to a more neutral guidance by scrapping its bias to tighten, could still push back on the May rate cut pricing, given sticky services inflation and wages. So they say that the Bank of England is projecting inflation to return to 2% or less in Q4 2025, which MUFG says is now way too optimistic, and the achievement of 2% target may now be brought forward by at least a year or possibly 5 quarters to Q3 of 2024. They also add that sticky wage inflation expectations could push out rate cut bets to June or even August from May. So if we do get some sticky wage inflation data, then, or even the CPI data itself, that's going to make it more obvious to the central bank that they're not ready to cut rates, and that there is still more work that needs to be done in order to then provide an environment where inflation in the wages side and consumer spending side starts to head down. ING said the Bank of England could drop its tightening bias both in votes and statement. So when we're talking about votes, they could all vote for no change, albeit maybe with one member who votes for a hike. Or you have a very dovish scenario where the majority of members vote for no change and then Dinger is the one who votes for a cut. Goldman Sachs analyst says that I think we should begin to see a narrative shift from the Bank of England from this meeting, with the potential for a 9-0 vote for a hold. And the January CPI print, we believe risks are skewed to the downside given a weakness in retail data. and look for further downside, in particular from household goods and clothing. So what was the market pricing like then? How has it been so far? So the odds, also on December 14th, the odds of a rate cut in May was still seen at around 94% currently, with 42 basis points of rate cuts priced in for June next year. And then January 19th, post weaker retail sales data, traders added to wages on Bank of England rate cuts and saw 114 basis points in 2024. 2023, January 23rd, traders pair Bank of England rate cut bets and see fewer than 100 basis points this year. Okay, there we are. So this is about 5 seconds before their release comes out, or had come out from the Bank of England on December 14th. So the rate came in as unchanged, and you had seen some strengthening from the pound off the back of the monetary policy monetary policy statement that had come through. Now, if we're looking at the ranges and deviations, which we'll go through in a bit more detail, which I'll show you on screen in a little bit, and the ranges and deviations. So the key sentiment then, and what was said from the Bank of England that led to the pound seeing strength, was that they were more hawkish than expected, and the Bank of England, which led to the strength in the pound. Most of the MPC majority say it's too early to conclude service inflation or pay growth is on a firmly downward path, and measures of inflation persistence are higher in the UK than in other major advanced economies. So wages inflation is going to be a key thing, whether or not they feel comfortable, and services inflation, if they feel comfortable that it's going to be on a firmly downward path. And with recent data, albeit you have had one good bit of data, i.e., if you're looking at if you're expecting the Bank of England to cut rates sooner rather than later, with the wages data, but you kind of need consistent amount of those releases showing a decline in the data, and that hasn't really happened. So we need to see more evidence, like the Bank of England would also want to do, of wage prices and services inflation continuing to head lower. Okay, so if we kind of skip forward, and we can see how the market reaction was. If we continue going, so you can see it was still continuing to go towards the upside here. Right. Let's see if we can. Yeah. Okay. So that concludes that little bit there of the past live stream that we had done. Let's get out of that as well. Now, one of the other things that I want to show you, and as I said, we'll go through the deviations of the economic release and which markets moved the most, which didn't. Now, this is what we call the deviation and ranges Google Sheet. Or otherwise, in a better way to put it, how strong was the market reaction to economic releases in the different markets. So we can see here with this initial figure represented there, that's at 40. We can see here this initial figure represents the initial move of the market going to the wick of the candle. And this is on a 1 minute chart, and we can see there was 48.5 or about 48.5 pips towards the upside. After about 10 minutes of trading is what the black bracket represents. It was still up, but did reverse some of its gains a little bit. It was up 42.1 pips. That's going to the end of the candle, and after about 30 minutes of trading, it was up 54.7 pips. Again, also going to the end of the candle. So this is quite useful in determining, one, what was the sentiment or what was said by the Bank of England, and why did that lead to this sort of reaction? And two, it's knowing how big of a reaction that you could see from the markets, and then determining what you would do in the best or worst case scenarios, let's say, or maybe the more, should I say, the more hawkish or the more dovish scenarios of the central bank. You can see when there has been a surprise in the markets back on the 21st of December, even then there was some strong movement from the pound, but the strongest movement overall consistently has been from GBP JPY with that currency pair there. So last time round we'd seen that there was 63.5 pips towards the upside, and after about 10 minutes of trading it continued to move towards the upside, about 85 to about 85.1 pips, and then after 30 minutes of trading it was up by 110 pips. So blowing everyone else out of the water with the market reaction. Of course, one of the main reasons is because of the amount of selling that has been going on, or had been going on, of the yen, and that the central bank is continuing to ease their monetary policy. So that's kind of helped the momentum not only in the UK when looking at the data, but also in the US, and to some degree in the euro area as well. But that had seen the biggest market reaction in the markets with GBP JPY in the currency space. All right, so as said, this is a recorded version of what would have been the live stream. If you do want to have access to the MACROACE main list, to be able to have access to this, to be able to see the updates that I do in real time, and then you can subscribe to the MACROACE main list. You will get an email on Monday morning from myself, giving you the week ahead of what to expect for the different sessions, Europe, Asia, and the US. It's not a big old article. It's quite short. It's to act as more of a refresher for the week ahead. And one of the other things to note is that you'll also have the live streams for the upcoming week ahead, if there are any, and we'll let you know if there are any live streams that are going to be done, and also the link to this here, the ranges and deviations Google Sheet. Okay, so good luck with your trading. Hopefully it goes well, and I will see you guys tomorrow though for NFP. So I will definitely be around then for NFP today, just not today. Okay.